Welcome everybody to the Building Equity Podcast for real estate investors. My name is James Schlimmer. The Fed just announced their 75 basis points increase, and I want to talk about what that means for real estate investors. I'm going to try to do it in 4 minutes or less, but to start, I got to give you my disclaimer. We are not giving you any investing advice here, right? Strictly for entertainment purposes. I'm telling you what's going on in my mind, not giving you any investment advice. I'd also like to let you know that this segment is brought to you by IRA Title Pro. If you are using your self-directed IRA to buy and sell real estate or lend on real estate, you should know about IRA Title Pro. Visit IRATitlePro.com, head over to the resources section, and you're going to see amazing tools you can use at every step of your real estate journey. I hope they help you out. Now you know about it. Let's talk about how the Fed rate affects real estate investors. So, 75 basis points is a huge hike. The Fed is committed to fight this inflation in our economy. What does that mean? The obvious thing is the connection between the Fed rate and the mortgage rate. If you want to know more about this, we just released an article at IRATitlePro.com/Fed rate, where you can get more granular. But essentially, the higher the Fed rate goes, the higher the mortgage rates go. As of before this announcement, the mortgage rate was 6.33%. A year ago, it was 2.86%. The higher the mortgage rate, the less buyers can qualify for a loan because their debt to income is thrown out of whack. Let me give you an example. Right? The median home price, according to the National Association of Realtors, as of right now is about $403,000. A year ago, the mortgage payment on $403,000 would be about $1,337. Well, before the Fed announcement today, that payment would now be $2,337, $1,000 more. That's a lot of money per month. That's a lot of buyers that can no longer qualify for that home. Right? If you can't qualify, they have to live somewhere. They remain renters, which is good for you. Now, analysts predict, and it makes so much sense that the Fed is committed to fighting inflation, right? That they expect a Fed rate to go to about 4.26%, right? I think right about now, with the 75 basis points, you're about 3.1, 3.2 is where the Fed rate is, right? So we could expect a 4.26% Fed rate in 2023, which would mean mortgage rates would be in the upper 7s or 8s, right? Well, if that's the case, that same mortgage payment would be $2,700. Again, the higher the rates go, the less buyers, the more renters, which is good for you. Now, I'd also like to point out, I do expect that the higher the Fed rate goes, the greater probability the unemployment rate increases. Google layoffs right now, and you'll see it's happening. What are you doing right now to be proactive in the event that your tenant was to get laid off? The beauty about real estate investing is that, yes, when this news is announced that the Fed increased 75 basis points and inflation numbers came in higher than expected, you can see the stock market immediately affected, right? That's people's 401ks, IRAs that are very equity focused, general portfolios that are equity stock focused, wiped out, right? Significant decreases. Has there ever been a better time to be a real estate investor? Because guess what? Your tenant more than likely is going to make their payment on the first of the month. You're hedging what's going on in the world. You talk about commodities. You got the Ukraine war. You got wheat. You got corn, food shortages. Real estate is a really good investment right now, bar none. Now, that's essentially what I wanted to be able to hit you. Yes, inventory numbers are still at record lows. I think they just came in August at about 779,000 according to active listings. It's normally about 1 million, 1.5, right? So those numbers are still relatively low, but yet we are up 90% in listings year to date, right? We're up 4% just from last month, July. So the more listings that hit the market obviously would bring down the home prices. But again, you've got strong millennials that are buying. You still have a very record low inventory numbers. I think home prices are going to remain strong, just that you're going to have less people to be able to qualify for them, which means more renters. So final thought here. I'm at the 4-minute mark. I went over. I feel so strongly that lenders are going to start getting creative with their lending to be able to get more folks in. I'm talking about adjustable rate mortgages here. If you look at the screen, you'll see where the interest rates were in 2004, where I would say the creative lending kind of started. I think we're going to see that again, right? In the event that happens, by definition, you're going to have people that default. Every single month, tune into this channel, subscribe. We're going to bring to you a foreclosure update where we're going to go through the data of what's happening statewide, nationwide, and zip code wide of foreclosure numbers, what stage of the foreclosures folks are in. I just believe this is where it's headed. I want to be able to bring that information to our real estate investors. We'll also dive into single family rental metrics all across the country, so tune in to subscribe. I hope this helped, and I look forward to seeing you guys again soon.